Many ILITs, or irrevocable life insurance trusts, are structured as grantor trusts for income tax purposes. And this is automatic, merely by the power within the trust held by the trustee to use the trust's income to pay premiums on the life insurance that's owned by the trust. Now, if current tax proposals, which might disregard grantor trusts for estate tax purposes, become reality and are passed, what that means is that life insurance in a grantor trust could become subject to estate tax. And guess what? That's going to capture most ILITs out there. So what that means is that any new ILITs that are created, if this law passes, will have to be non-grantor trusts. And existing ILITs that have any premiums outstanding after the law changes, if it does, will have to be modified or decanted so that this grantor trust power is removed. And you can't get there with a sale of a policy to a non-grantor trust because that will violate transfer for value rules. There could also be increased gift taxes for any transfers to the trust of principal to pay premiums, because if the estate tax proposals are passed, the grantor will have a cap of 2 times the annual exclusion for transfers to the trust. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode 187, is all about the future norm for ILITs. Will non-grantor ILITs become the norm when it comes to life insurance planning for estate tax in the future? Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to the presentation. Now, ILITs, or irrevocable life insurance trusts, are trusts that act as the owner and the beneficiary of any life insurance policies on the life of the grantor. Now, you could also have 2 grantors, maybe a married couple, and the trust might be the owner and beneficiary of a joint and survivor policy. But the ultimate goal of this planning technique is to avoid the application of a rule that says if the insured dies as the owner of the policy or transfers ownership within 3 years of death, then the death benefit will be subject to estate tax. That's a punitive rule, and it's low-hanging fruit to get around that. Now, from an income tax perspective, it's important to note that generally, payment of a death benefit on life insurance is not an income tax event. Life insurance proceeds are generally excluded from gross income, but subject to an exception we'll look at towards the end. But when it comes to the lifetime of the trust, before the death benefit ever pays out, the income tax treatment of the ILIT can become important, because the way that the income of the trust can be used with respect to the life insurance can cause it to be a grantor trust. Now, with an ILIT, you can choose to either fund premiums through annual transfers to the ILIT, which creates principal of the trust, or through income that's generated by the principal of that trust. Now, there is a rule that says if any income of the trust is used or can be used to pay the premiums on life insurance on the life of the grantor or the grantor's spouse, that would cause the ILIT to be a grantor trust under Code Section 677. So, if you don't have this funding mechanism to have income that can be used to pay premiums, then those premiums must be paid with principal, which is usually created through annual transfers to the trust in an amount equal to the premium on the life insurance policy. Now, currently, transfers to a trust are transfers of future interests typically, which wouldn't qualify for the gift tax annual exclusion. So, any of these transfers of premium payments are typically subject to crummy withdrawal rights so as to qualify for this gift tax annual exclusion. But the big picture here is that regardless of the funding method, if you merely have the power given under the express provisions of the trust for the trustee to use the income to pay premiums on the life insurance, that will cause this to be a grantor trust. Now, that could be an issue if the current tax proposals under the Bernie Sanders for the 99.5% Act are passed, and I've covered that act ad nauseum in prior episodes. But long story short, a grantor trust is a trust that's disregarded for income tax purposes only, but is respected for estate and gift tax purposes. Now, if this act is passed, one of the significant changes that's proposed is that grantor trusts will also be disregarded for estate and gift tax purposes as well. So what that means is that any assets in the grantor trust are included in the gross estate of the grantor. That would include life insurance in the case of an ILIT that's a grantor trust. So what this means is that once this act passes, new ILITs are going to have to be non-grantor trusts because their express provisions will have to prohibit the use of the income to pay premiums on life insurance. And for existing ILITs, you'll have to look at whether there's any premium payments that remain to be made, because if they're grantor trusts on the date of enactment, any transfers after that date will cause it to be a partial grantor trust. So existing ILITs are going to have to be reformed or modified so as to make them non-grantor trusts. And there's no substitution power here that you can simply turn off. The mere power of the trustee to use income to pay premiums is enough to cause this to be a grantor trust, whether or not there is an actual substitution power in the trust itself. Now, once you have a non-grantor trust, you have to get into the funding issue. How do you fund premiums with principal payments? And if you don't have principal in the trust to begin with, then you have to create it through transfers annually, which could be subject to crummy withdrawal powers. Now, there's another change on the horizon in this Bernie Sanders Act that says no matter what, you get the $15,000 annual exclusion per donee, whether or not you're making a gift of a future or present interest, which will eliminate the requirement that we have crummy powers. So that's a plus, but the minus is that the grantor is going to be limited to 2 times their annual exclusion for transfers to irrevocable trust. So what that means is that between the ILIT and any other trust that's funded during the year, you can't exclude more than $30,000 from the gift tax. That's 2 times the annual exclusion. And obviously that's indexed for inflation. And crummy powers are disregarded in that, so you can't get more than the $30,000 simply by giving the crummy power. So we'll remove the requirement for crummy powers, but crummy powers are going to be disregarded in determining whether this $30,000 threshold is met. And any amount over that $30,000 threshold will require a gift tax filing and use up some of the grantor's applicable credit, which will be based on a much lower exclusion potentially of $1 million. And there's also GST tax issues that come into play, but that's a subject for another time. Now, for truly thinking minds out there, you might be thinking about the semantics of income within the trust that can be used to pay premiums. And within the grantor trust rules and the trust income rules, there's really 2 definitions. There's a traditional trust accounting definition of income, which excludes capital gains because those are allocated to principal, and doesn't really take into account tax-exempt income. Well, it does take into account tax-exempt income as income from an accounting perspective, but typically those items remain as part of the principal of the trust if you have capital gains items, and while that would be treated as accounting income of the trust for tax-exempt income, it's not necessarily an item of income for tax purposes because it's tax-exempt. Now, one big picture item here is that if you're truly thinking about this, you might wonder, hey, could we still use tax-exempt income and capital gains to pay premiums without running afoul of this grantor trust rule? And the answer is likely no, because Code Section 677 and its regulations generally apply a broad definition of income, which looks to any type of income, whether taxable or not taxable. So it's likely that a grantor trust would look to the use of any income, whether or not it's allocated to principal, for payment of insurance premiums. So, long story short, what that means is that if the trustee could use tax-exempt income or capital gains to pay premiums, it still may trigger the grantor trust status. Now, it's something worth digging into as well, but I also want to highlight that this isn't an issue of whether the income or principal is used to pay premiums. It's really an issue of whether the trustee has the power to begin with. So regardless of what the source of income or principal payment might be, the mere power of the trustee to use income to pay premiums is enough to cause it to be a grantor trust here, which is very punitive seeming. And with that being said, this might be a worst case scenario. We don't know if this act is ever going to see the light of day, but if it does, it's something to keep in back of mind. And for action items, what we need to look at is for existing ILITs, there may be a change needed. So if you have clients with ILITs, or if you yourself have an ILIT, it's worth it to dust it off and see if it does have this provision that allows the trustee to use income to pay premiums. If it does, you're going to have to look at modifying it somehow, maybe by decanting to a new non-grantor ILIT, which creates a new 3-year period potentially. You could have judicial or non-judicial modification for existing ILIT, or even a trust protector action for an existing ILIT. Now, any of those could have income issues in and of themselves, and with that being said, note that I didn't include sales of a policy to an ILIT, because this is a big no-no with a non-grantor ILIT, because there's a transfer for value rule that can kick in where there's a sale of a policy and could cause the policy death benefit to be subject to income tax when paid, minus the purchase price and minus any premiums subsequently paid after the purchase. Now, that could rear its ugly head with a sale to a non-grantor trust, because a non-grantor trust doesn't fit into any of the exceptions to the transfer for value rule. Now, my curiosity is whether such a treatment, where maybe you have a sale to a non-grantor trust which causes the proceeds to be subject to income tax, whether that would cause that to be income in respect of a decedent or IRD, which would be taxable to the trust, but might also allow for an estate tax deduction against the policy proceeds so as to avoid double tax. Once again, I don't have the answer for that, but for the time being, there's lots of things to keep back of mind that may require reformation for ILITs in the future, if indeed this tax reform does become reality. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.